Following our recent look at Byrna Technologies, today we're shifting focus, really digging into a major, long-standing player in the U.S. firearms industry, Sturm, Ruger & Company.
That's right, and the material we've reviewed, well, it presents a really sharp conflict, almost a paradox when you look at Ruger's current situation.
It forces a pretty fundamental question, doesn't it? You've got this incredibly strong balance sheet, almost fortress-like, and pretty significant recent stock momentum. But does the company's very, very firm commitment to its traditional base, does that strength outweigh what look like some serious operational risks? We're talking volatile, contracting sales, and frankly, some deeply depressed current profit numbers.
Exactly, and that's the core tension. I'll be arguing that yes, that financial structure is the key. It provides genuine resilience, and the market is, I think, correctly anticipating a significant profit rebound. Ruger is defensively positioned because of that balance sheet.
And I'm going to challenge that. I think the severe lack of current profitability, combined with what I see as pretty serious strategic and governance headwinds, well, it makes the current high stock valuation look tenuous. Possibly unsustainable, actually.
Okay, let's lay out the cases then. My core argument is that Sturm Ruger is fundamentally a financially robust company. It's built almost by design to withstand the kind of market volatility that just defines this whole sector. And the proof really is right there on the balance sheet. It's undeniable.
Okay.
Look at the liquidity. It's exceptional. They have nearly $4 in liquid assets for every dollar in current liabilities. That's a current ratio of 3.96. The quick ratio, stripping out inventory, is still over 3.03. And maybe most importantly, their capital structure is basically debt-free, a debt-to-equity ratio of just 0.01.
Now, that financial health provides this huge, tangible cushion against the inevitable down cycles in sales. It gives them maximum operational flexibility. And we see this strategy actually playing out. They've got $6.27 in cash per share, and they recently used some of that strength for an opportunistic strategic move, buying assets from Anderson Manufacturing, likely trying to consolidate market share while others might be weaker.
Right, the Anderson deal.
And yes, look, the trailing 12-month earnings per share is deeply negative year over year, no doubt about it. But the market is overwhelmingly forward-looking, always is. The forward PE is sitting around 22.26. Contrast that sharply with the trailing 12-month PE, which is way up there at 150.13. That massive difference clearly signals the market expects a huge earnings recovery, something like 522% growth next year.
500%, yeah.
Yeah, from about 31 cents TTM EPS to a forecast of $2.08 next year. That expectation, that anticipated rebound, that's what's driving the stock's performance. That 31+% gain year to date. The market basically thinks the worst of the cycle is behind them.
Your entire valuation argument there hinges on this massive, 500+% hypothetical recovery.
Well, it's a forecast, yes.
Right now, though, the company's actual profitability is, well, it's alarming. Trailing 12 months net income is only about $5.76 million. That's the number underpinning that astronomical TTM PE ratio of 150 you mentioned. That is just not a healthy operating profile, period. And what's more, we're seeing what look like structural problems reflected in the top line. Sales have declined almost 10%, 9.83% over the past 3 years. So this recent stock performance, nearly 28% gain last month alone, and an RSI, Relative Strength Index, way up at 83.51. That suggests the stock is really technically highly overbought.
Okay, but momentum.
This momentum feels totally divorced from their recent operational results. Quarter-over-quarter EPS declined, a staggering 324%? This operational stress, I think, is amplified by their strategic choices. Management's rigid approach, prioritizing the core customer, resisting diversification, actively pushing back against things like smart gun technology. It exposes the firm to extreme political risk and market volatility. This conservative stance, while maybe loyal to the base, has already brought successful shareholder activism to their door. And critically, we've seen substantial, very recent insider selling from key people like director Christopher John Killoy. That tells you something about what those closest to the company think about its immediate future.
Okay, Killoy's sale is noted, but let's talk about that forecast credibility.
because you rightly point out it's core to my thesis.
It absolutely is. You mentioned the balance sheet resilience, but that 522% forecast, right now, actual operating profitability is razor thin. Profit margin is just 1.07%. Operating margin even thinner at 0.54%. How can we really trust such a massive, transformative EPS growth forecast when, as I said, sales have been structurally declining for 3 years? And maybe more concerningly, the new CEO himself has already indicated that the price repositioning moves they need to make, basically to shift inventory, are expected to further impact the 2025 bottom line. So you're kind of basing your investment case on an expected rebound into a volatile market while seemingly ignoring the operational headwinds that management itself has already acknowledged.
I think you're focusing too much on a point-in-time snapshot of margins. Yes, it's during what we both acknowledge is a cyclical trough, but you're not fully crediting the mechanism that allows them to survive these troughs. The sheer strength of that liquidity, that current ratio near 4, means Ruger can absolutely endure these periods of low profitability.
Endure, maybe, but thrive?
You asked about credibility for the forecast. Okay, the confidence in that 52% number comes from a few places. First, the whole industry is normalizing, right? We had that extreme demand spike during the pandemic and all the subsequent political uncertainty. This current weakness isn't just a Ruger problem. Their competitors like Smith & Wesson face similar pressures. Second, the Anderson Manufacturing acquisition, it's a concrete step. They're consolidating market share while the industry is weaker, positioning themselves for maximum leverage when the cycle inevitably turns. The forward PE isn't magic. It's just pricing in a return to a more historically normal cyclical profitability level. And the lack of debt isn't a failure. It's a powerful advantage. It lets them make these strategic acquisitions without loading up on future interest payments.
Okay, I'd push back a bit on the idea that low debt is purely an advantage, especially when you pair it with falling sales. Couldn't low debt also indicate maybe a failure to invest aggressively countercyclically, or maybe a failure to diversify more robustly? They are incredibly reliant on that core firearms segment, and that just invites unnecessary political exposure, in my view. And before we move off strategy, I really want to pivot slightly to the governance side, because I think this fundamentally undermines your point about operational flexibility.
Okay, how so?
You're right. Their strategy focuses on the core customer, and that likely maintains brand loyalty, but it comes at a significant cost. Governance risk. That insider selling we mentioned, especially from officers and directors, it suggests the lack of confidence from the people who have the most intimate knowledge of the operational struggles.
One director selling doesn't necessarily mean.
But more critically, look at the successful shareholder resolution demanding gun safety reports. That demonstrates a real, tangible conflict. This kind of activist pressure forces management to divert time, capital, attention away from core business goals like maximizing profit from their two segments, firearms and castings, and towards these, let's be honest, politically charged and socially motivated reporting exercises. That absolutely constrains the CEO's operational latitude. It forces them to allocate capital potentially against their preferred strategic direction.
That's a compelling argument about the constraints. But look, every public company faces governance scrutiny. The data breach class action settlement, yes, $1.5 million. That's certainly concerning as an operational failure in, safeguarding customer data. But it feels like a one-time charge, not really a structural threat to the whole business model.
It points to operational deficiencies, though.
Perhaps. But when we talk about the core customer strategy, we have to recognize this is a calculated choice. The loyalty of that Second Amendment base is what ensures a stable, baseline demand. It helps insulate them from some political headwinds that might hit broader consumer markets harder. And let's be clear, this isn't a company resting on old tech. Their ability to innovate is pretty clear if you look at their patentless advancements in triggers, barrels, suppressed handguns. They innovate within their core competency, which is arguably the most profitable path for them.
Okay, let's circle back to valuation then, because that's where I really have to push back hard. Your argument relies on future potential, but the current valuation metrics look speculative to me. The stock is trading right near its 52-week high. That 28% gain in just 1 month, it feels speculative, and that RSI over 83 is basically screaming overbought.
Technical indicators can be noisy.
Based on those razor-thin trailing earnings, the valuation, that PE of 150, is just,
Well, it seems absurd. It simply cannot be sustained if that highly optimistic EPS recovery forecast fails to materialize. And as we've discussed, that recovery is far from certain given the operational issues and strategic constraints.
The market is pricing in what we both acknowledge: the strength of the balance sheet, the fortress, and yes, the inherent potential for regulatory or political events to suddenly drive future demand surges, which is just the historical pattern in this sector.
So pricing in hope?
I'd argue the extreme liquidity means the company's actually undervalued relative to its financial stability. Yes, the price momentum looks aggressive, but I think investors are placing a bet. They're betting that the new CEO, Todd Seyfert, who came in January 2025, has been given the mandate and trust to execute the strategy of portfolio realignment and price repositioning that was mentioned in the Q2 reporting. They think he can effectively reset the cost structure just in time for the rebound. The price performance reflects anticipation of this necessary structural change.
But again, when we see key executives like Illinois selling significant chunks of stock right before the supposed turnaround, you have to ask if management actually shares that investor confidence in Seyfert's ability to execute, especially amid all the activist pressure. That internal divestment hints at a potential conflict between management's perhaps more cautious short-term outlook and the market's much rosier long-term optimism.
Okay, to wrap up my side, Sturm Ruger maintains this extraordinary, virtually debt-free financial foundation. It really acts as a profound structural cushion against the volatility that's just inherent in this sector. Yes, trailing profitability is undeniably weak right now, but the market is forward-looking, and it appears to be anticipating a robust rebound in earnings, supported by strategic moves like the Anderson acquisition and ultimately stable operations in their core firearms and casting segments. That financial flexibility gives the new leadership the runway, the bandwidth to execute the necessary portfolio adjustments.
And from my perspective, look, I'm sorry, but I just don't buy that the financial stability alone compensates for the current quite severe lack of profitability and these significant strategic and governance headwinds we've discussed. Investors have to weigh that very appealing low-debt safety net against, well, the clear evidence: falling sales over 3 years, activist pressure that demonstrably constrains capital allocation, and recent substantial insider selling. All of these pose credible, long-term threats to capital deployment and margins, regardless of whether a cyclical upswing eventually happens or not.